Hello everyone, welcome back. In the last video, we had discussed the first factor which contributed towards a financial crisis, which was mismanagement of financial innovation and also financial liberalization. In this video, we'll discuss the other two factors, which are the asset price boom and bust and increase in uncertainty. So, with the asset price boom and bust, you have to understand that asset can be of any type. It's not necessarily it would be a stock, it would be a financial asset. The asset could be of any type with a financial crisis. It could be a real estate, it could even be a tulip, it could even be a flower commodity like this. For it, you can read the Tulip Mania, which happened in the 17th century during the Dutch Golden Age. I'm writing certain keywords so you can type them out on the internet and you can look it up. So it can also be a financial instrument. So asset can be of any type during a financial crisis. And what happens during a financial crisis is the prices go crazy. They rise crazily, and when the financial crisis comes to a culmination, they drop. They drop and they never pick up. Usually never pick up, or maybe they pick up after a very long period of time. So let's explain what happens during a asset price boom and a bust. Firstly, there is a asset price bubble. So what is an asset price bubble? You know, a bubble gets inflated more and more as and when more air is entered into it. And once it has reached its maximum capacity, it is going to burst, right? It's the same case which happens with an asset price boom or a burst. So there is an asset price bubble. So let's see, how does it take place? How does a bubble form? How does it swell up so that it comes to a point of a burst? So first what happens is, price of a real asset or share are driven by investor psychology. And also, mind you, there is endless literature explaining the asset price boom and bust, why it occurs. Why it occurs. So in this part, I would like to focus mainly on investor psychology, which is also known by Keynes as John Maynard Keynes as irrational exuberance. It is often referred to in the literature as irrational investor exuberance. So they are very happy about the asset, they are very excited about the asset, and what psychology drives them, it drives them to buy more of it. And there is a investor psychology, the prices of the real assets are driven, and they are driven well above their fundamental economic value. It would be very useful to you to understand all these terms, because when you read the literature, you'll come across these terms as fundamental economic value. So what happens is, the price of a asset, which can be, as I explained, can be a real asset or it can be a share, it drives above the fundamental economic value, what it is worth, and it is due to an irrational exuberance, irrational excitement in the market. So now, and as in the last class you would have seen what would happen because of a weak government, because of government safety nets and weak market discipline, there is a credit boom. And often these credit booms fuel these asset prices. because this is where the money is coming from. So these credit booms fuel asset prices, and once these credit once these credit booms are followed by a credit bust, so does there is we can say there is a bubble burst too. And because you have to understand all these factors are closely intertwined with each other. This bubble would never have inflated, this balloon would have never have been inflated had there not been a credit boom. But because there is a credit boom, the prices rise. So the bubble burst, what happens when bubble bursts? There is a realignment of the prices with their fundamental value. So there is a realignment with fundamental economic value. With it, what happens as the prices have driven down? Firms' net worth also decreases. As we had seen in the credit boom and credit burst, it led to driven down, or I can say it led to decrease in the net worth of banks. Net worth of banks. And now with the asset bubble burst, the firm's net worth declines. Now as the firm's net worth will decline, these firms are the borrowers. The collateral will also decline. The value of the collateral is also will decline. Now you see how all these factors are so intertwined with each other because this burst happened. Now the collateral has given down, and it is going to even worsen the net worth of banks. It is even going to worsen, and which will eventually lead to a banking crisis, which is the stage 2 that we'll discuss in a while. So now this is a very interesting thing. Now see, we would say that, oh, see, the prices are driving down, prices are decreasing. Why would investors want to stay in the market? They would rather want to take out their money from the stock market and put it in some safe thing. But no, you have to understand the irrationality that is taking place here, and you also have to understand the beauty of the problem here. Kind of it's a hazard, but you have to understand. Now, first, because they now don't care anything, so they have less skin in the game, because they are of the fact, well, I'm losing this much, I don't mind if I lose even more, but let me take my chances, right? a, a good shot might give them good returns, and it might help them to recover the losses. So what will happen when they have less skin in the game? They'll become very reckless, and the market discipline was already very, very weak, so it would be more risky. So they'll indulge in more risky investments. And when they do this, we had understood yesterday in our previous class, it was the problem of moral hazard. So this problem of moral hazard worsens because of this less skin in the game mentality. And now the banks are losing, everybody is losing. All of a sudden, the lending standards strickens. So because of the firstly they had poor lending standards, they were lending to subprime borrowers. Now because they're losing so much, they are kind of there is a second moment of awakening with them, and the lending standards stricken. There is deleveraging. So when deleveraging happens, you should know that aggregate demand will fall. So aggregate demand will fall and eventually the asset prices decline. So do you see one thing which is happening with all the mess that is happening? There are certain corrections that are taking place. So yes, the financial crisis, because, and these corrections will take place because the financial crisis reveal the cracks in the market. So these corrections may take place simultaneously as the crisis happens, because now everybody wants to pull up their stocks, or it may happen after the crisis. So the lending standards will stricken. So this is a kind of a corrective action which should have been taken earlier, but they are now taking. It's taking place now. So you see what had happened in the asset price boom. Just a quick revision. Because of this credit boom, because of the credit boom and this irrational exuberance by the investors and a weak market discipline, poor government, huge government safety nets, poor government regulation, the prices of the assets were well built above their fundamental economic value. When these prices were above their fundamental economic values, use with they just go the prices rise. Now there is a credit burst, there is lending freeze. With the lending freeze, the bubble also bursts, and there is realignment. When the realignment happens, with realignment the firm's net worth also decreases. The firm's net worth decreases. As the firm's net worth decreases, the value of collateral decreases. Now, because they have less skin in the game, with this mentality, this is a very important thing to know, because this is a problem of moral hazard. There's more risky investment, the lending standards will stricken, and deleveraging and the asset prices will decline. So eventually the prices rose, prices were high, and they will come back to their fundamental economic value. Now let's discuss in brief increase in uncertainty with the onset of financial crisis. So what happens? Why do I say that there is increase in uncertainty? It comes with the problem of asymmetric information as discussed in the previous lecture. So with uncertainty, the information is hard to come by. So because of this, the problem of adverse selection, moral hazard, they'll increase, and which will eventually seep into the lending contracts. So the lending contracts will become more strict, and when the lending becomes stricter, there would be lesser lending and the aggregate demand will fall. So from all the three funds, the economic activity is declining. So aggregate demand is falling. That means the economic activity is declining. Thank you very much. In the next video, we'll discuss the stage 2 of the financial crisis, that is the banking crisis. Have a nice day. Bye bye.